A lot of Americans have started doing something strange. They're double checking their bank account before calling the doctor. It's not because they don't have insurance, but because they don't trust what the bill will look like afterwards. And that's why medical debt is rising, even among people who are insured. Most medical debt doesn't come from emergencies. It comes from things people consider a routine, a test, a scan, a follow-up visit, lab work. People walked in expecting a copay, and weeks later, a bill shows up for hundreds, sometimes even thousands. It's not because something went wrong, but because the deductible wasn't met, or the provider was out of network without warning, or coverage didn't kick in the way they expected. So that gap between expectation and reality is where medical debt usually begins. Health insurance didn't suddenly break. It changed quietly. Over the past few years, many plans shift how risk is shared. Instead of insurance absorbing the cost early, more of that responsibility moved onto households first. That showed up as higher deductibles, higher out-of-pocket maximums, narrow networks, more cost sharing at every step on paper. Coverage still exists, but in practice, people are responsible for more of the bill before insurance really helps. That's why a routine appointment now comes with hesitation. Not because people don't care about their health, but because they learn that the bill doesn't always match the visit. Insurance used to feel like protection. Now, for many families, it feels like a calculation. Medical debt rarely starts as one big bill. It usually starts small. Someone gets a statement and think, I'll deal with this later. Or they put it on a credit card. Or they set up a payment plan. None of those choices feel dramatic, but that's how it enters the household's budget. A few months later, interest is running, fees have stacked, and that temporary balance is still there. Now, it's competing with rent, groceries, utilities, and insurance premiums. Medical debt doesn't replace other bills. It is squished between them. That's when people start juggling, not because they overspend, but because one unexpected cost changes the math. And here's why this matters as we move into 2026. Not because of the sudden crisis, but because of how the system resets. Every January, deductibles go back to zero. That means family starts the year paying the first dollar again, even if nothing else changes. At the same time, many employers' plans continue shifting costs quietly. Premiums edges higher, coverage thresholds move, out-of-pocket limits rises. None of this shows up at the headlines, but it changes behavior. People delay care early in the year. They wait to see how the budget feels. They hope nothing unexpected happens. And when something does happen, the financial impact hits faster because there's less cushion at the start. When medical debt enters a household, it doesn't stay in one category. It changes behavior. People delay follow-ups, skip preventive care, wait and see if something gets better on its own. Financially, the pressure spreads. Savings stop growing. Credit cards carry balance longer. Other bills get pushed just a little later. Not because people are careless, but because uncertainty changes decisions. Medical debt doesn't just take money. It takes confidence. This isn't about blame. This isn't about politics. It's about recognizing a shift. Health insurance still exists, but for many households, the protections feel thinner. The cost feels harder to predict, and the financial risk feels closer home. When people with coverage still hesitate to use it, that tells you something important about the economy. That's what we watch here, not the headlines, the impact on everyday wallets. Thank you for watching.